Well, welcome everybody. Thank you for joining us for this sneak peek into our predictions for 2025. This time last year, my partner Ryan Hinkle and I discussed our predictions for 2024, and we kicked off with a quote from Charles Dickens about the best of times, the worst of times, the spring of hope, the winter of discontent. Well, we're a long way from the dichotomy of that sentiment. And so perhaps as we look towards 2025, Shakespeare comes to mind this time, particularly the prophetic words in The Merchant of Venice, which is all that glitters is not gold. And perhaps that could be said of AI today. So we'll get started with our panelists navigating through the comedy, the tragedy, the drama of 2025 predictions. My partners have very impressive bios, Lonnie Jaffe, Dion Chinku, and Thomas Crane. They speak for themselves, and you'll get some insight into such stuff as dreams are made of, which is another Shakespearean quote, this time from The Tempest. So the flow of the conversation will be, first we'll discuss technology predictions, and then we'll discuss market predictions by zooming back out. And so our first prediction is that, generative AI will become the baseline expectation versus a competitive edge. And so, Thomas, I'm going to jump first to you because in the article that Deanna references that we just published, you made the comment that Gen AI features do not lead to inherent moats and will increasingly be perceived as table stakes. What do you mean by that?
Thanks, Hillary, and thanks everyone for having me. Look, what we have seen over the last 10 years is this rise of kind of the first wave of SaaS. And what we're seeing now is this kind of second wave of, I guess you could call it AI-enabled or even Gen AI-enabled SaaS. And there's this question, is it going to be the incumbents who have the data and have kind of the customers that are going to have the advantage, or is it going to be kind of net new innovators that come to the table with kind of a fresh cloud-native architecture, cutting-edge models, and the most smart R&D folks to build the best product? And I think whether it's one or the other, you need to have some sort of generative capability if you're going to be in a leadership position. And what I think we're starting to see is specific within vertical markets, and this is to my point on Gen AI doesn't lead to inherent moats. There's a lot of workflow, there's a lot of know-how and domain-specific elements of what make those applications so critical, mission critical to a specific hospital, healthcare, education technology, and it goes far beyond what LLM can provide outside the box. Now, if you miss a critical capability that is unlocked by LLMs within this context of that vertical app, then that is going to expose you to a potential new entrant. And that's kind of what I meant by that. But I'd also love to hear from some of my fellow panelists, because maybe there's some disagreement on whether, table stakes is the right way to frame, the sort of requirement for Gen AI and vertical SaaS.
Well, Lonnie, it's a good love from Thomas. I mean, last year our prediction was that GAI would go from experimentation to adoption. Have you seen that play out? Is GAI now a necessary condition to compete?
So I think the way I've been thinking about it is that Gen AI just hasn't changed the rules of business. You still need sources of defensibility and moats and economic power. And so the first wave of capabilities that we've seen come out, a lot of them were coming from category leading incumbents who have products that customers love, adding Gen AI capabilities as features. And those incumbents, they're high growth incumbents, so the kind of companies that Insight has in its portfolio, they have sources of defensibility like trust and brand reputation and distribution and a user base that loves the product, economies of scale, network effects, platform effects. They have access to proprietary data themselves, but then their customers also store data in their products and trust them with it, right? And that kind of integration with existing products that have delightful craftsmanship, was the kind of first wave of successful Gen AI systems that we saw. But there's also an enormous amount of capability that's being shipped by the frontier labs themselves, almost application-like capability in some cases, right? You can ask a raw language model from most of the large foundation model players questions about medical issues or legal issues, and out of the box, they're quite capable. And then you are seeing kind of early signs of companies that are coming into a space with an application, going after a category leading incumbent with the idea that, you know what, you're just not going to do this the same way anymore. There's a new way to do this. Yes, you have an existing product, but it's sort of like a legacy taxi dispatch company when Uber shows up. It's like, it can be a really good dispatch company, but it's just not the way you're going to do it anymore. And then I think I think it's also important to remember that there is a category of incumbent that have products that customers do not like. And there, I think Gen AI can actually be more of a threat than a tailwind, in the sense of if you have customers who dislike your product and the only reason why they continue to use it is because of switching costs. There's a scenario in which, let's say, the switching costs are, it takes a while to rewrite something from your system to another system, or it's hard to get the data out. There's a scenario in which Gen AI can make something that was previously not that automatable, like replatforming off of your system, which they already don't like. It can make that significantly easier. So in those cases, I actually think it can be a bit of a threat.
That makes sense. I want to pick up on the notion of building GAI into your product. And when we look at our scale-ups, we see two areas that GAI is impacting their businesses. The first is on product strategy, as you alluded to, Lonnie, and the second is on operational efficiency, incorporating Gen AI into your workflow and into the way you run your business. And so just picking out on you, Lonnie, and then we'll jump to you, Dion. Lonnie, on product strategy, because you were just talking about it, we've heard a lot about agentic. So as we start to think about what's the next wave of product strategy, it's not just Gen AI, but now we're hearing the application layer. We're thinking about agentic AI. Maybe you could talk a little about where this goes in 2025.
Yeah, so I think we'll see a number of different multi-step agent-like capabilities get increased adoption in 2025. So one is, and it's been getting some buzz recently, but I think it's still somewhat underappreciated, is the inference time compute capability we're seeing with things like OpenAI's O1 model. So this allows the models to take additional time to think or process information and then generate significantly more intelligent outputs in that way. So instead of responding instantly, they can break a problem into steps, they can plan the solution out, they can evaluate the quality of each step. They can maybe run many parallel instances of each step and evaluate them. If they hit a dead end, they can backtrack and correct themselves. And this takes more time and expense, but it also unlocks an enormous potential for especially the more complex problems. Today, these multi-step systems are mostly being used to just reason through problems more thoroughly. But it's not a long stretch necessarily for them to be able to do things that have multiple steps to them. And another kind of agent type thing that we're seeing are existing application vendors. I think our portfolio company, CentralReach, is a good example of this, that are adding agentic-like capabilities to their own products. That is Gen AI capabilities that use their product as a tool to do something like document session notes or generate claims or check claims. In their case, they're practice management and clinical software for clinics that treat people with autism. And the incorporation of AI into products like that can feel magical to the customers. And in their case, it's driving a material portion of their ARR this year. And then finally, there are a number of that kind of single purpose or specialty agent-like startups that can work across different systems. And I think some of those could start to see some real adoption and growth in 2025 if they can find use cases where the reliability and trust get high enough.
Makes sense. Dion, as Lonnie alluded, some of these incumbents are incorporating into their current product stack, and our portfolio companies use some of those incumbents to run their businesses. So have you seen that adoption just in terms of operational efficiency? Is it playing out, or is it still a promise yet to come?
Yeah, 100%. I think you're certainly seeing the pickup in adoption. Almost every company is experimenting with some form of Gen AI use in their daily operations today. I think starting with some more basic use cases, right? Like you're seeing a lot of like sales forecasting, customer segmentation, risk assessment and starting there. I think you're also seeing some early experimentation on just emerging use cases, right? So a lot more increasing focus and attention on customer behavior prediction and personalization. I think you ask about efficiency, and I think it'll be interesting to watch to see how this plays out. I think, I'm sure everybody on this call probably has experimented with Gen AI themselves in both work and life. And it's hard not to say you're experiencing some efficiency, right? I think everyone has achieved something that they've managed to kind of automate away or be able to do more simply with the help of AI. I think the broader question on efficiency is, when will that start to actually translate into, the actual budgets and balance sheets of these companies? And I think it'll come in phases and waves, right? Like, I don't think in 2025 you're seeing this wholesale replacement of FTEs because AI is here and actually replacing jobs today. I think you're seeing lots of folks gaining some efficiency in small ways, and you're seeing maybe that backfill doesn't get backfilled because you're finding different ways to actually achieve that task. And so I think it'll be interesting again to see how it plays out. But I think in the medium term, what you'll see is FTEs will probably still be here to stay. In many of those roles, even where AI is being largely used, you're going to see an increase in kind of data infrastructure spend taking up at the same time as folks continue to experiment with each of those new tasks and roles. And, I think over time, as people figure out the balance between, what is kind of, what can be automated with AI and that spend, and that hosting spend gets allocated back essentially to the functional departments where they're having impact. I think that will be when we'll have a little more clarity on like the true ROI of this spend shift and whether, the trade-off of headcount versus technology balances out to a place where we're seeing efficiency in the long run.
Yeah, that makes sense. And what you're talking about is a lot of the kind of horizontal apps, those that really support multiple areas of functional capabilities in portfolio companies or in companies in general, sales, marketing, product development, customer success, etc. I want to turn therefore to vertical SaaS, because I think, Thomas, you alluded to it a little earlier. And this is our second prediction, which is that the original cloud disruptors, those who disrupted 10 or 15 years ago, today they're incumbents. And, I think about something in cybersecurity like CrowdStrike, which, probably can be thought of as an incumbent these days. These companies are adding AI to their feature set in order to stay relevant. So, is for them going to be an add-on, or will there be new business models that emerge and new companies emerge that actually challenge those quote unquote current incumbents?
Sure. No, look, cyber is a really interesting case study of AI because, Insight, we've been investing in AI cyber for probably 10 years now. Companies like Darktrace and SentinelOne, Recorded Future that have had AI integrated into their product set really was some of the fundamental advances to fight, malware and bad actors in terms of having a probability distribution to determine, whether something is malicious versus signature-based reactive system. And now we're talking about this new wave, which is more the generative wave. And I think absolutely it's going to create new attack surface area, which is going to necessitate new best of breed point solution companies to emerge. I think what happened over the last 10 years within cyber specifically is this sort of unbundling that was unlocked by basically the market accepting that cloud native cyber is something you can do. You don't have to have it installed on-prem or behind a firewall. In fact, that's just a paradigm that doesn't make sense today in this kind of massively distributed world. But as companies that have had sort of the first wave of AI adoption in cyber in their cyber solution set now have to reckon with these kind of new generative driven attack surface areas, they're going to rely on M&A to drive kind of the innovation that's going to have to be reactive to that. And it's going to potentially lead to some brand new platform companies to emerge. As we saw with our own portfolio company, Wiz, that was able to kind of emerge from this mass adoption of cloud and the necessity to secure those workloads. I predict that there should be a similar type of new platform company, standalone, independent, best of breed for generative AI security. Now, what does that actually mean? It's a big topic, right? From everything from prompt engineering and manipulating agentic systems to get to data that you shouldn't have access to Lonnie talked about agentic AI that can go and access and use applications to produce results. Well, who's controlling the identity and authorization use of those applications? Imagine, you know, a type of malware that knows exactly how to manipulate those agents, just like a phishing attack manipulates, you know, a human user. Well, that's all a new frontier. It's completely uncharted territory from even the largest and most advanced incumbents in cyber. And I think it's going to create a really exciting shakeup in terms of shifting from this kind of platformization of cyber, which we've seen happen in the last 3-4 years as, you know, venture funding has decreased. And I think it's going to drive now the pendulum back to this best of breed notion with all of this new surface area emerging.
Interesting. There's also shakeup happening in the developer world. I mean, Dion, you're involved in SonarSource, which is, you know, a company that ensures developers produce great code. You know, we've all heard about the 10x developer. Is this a kind of notional idea, or, you know, are we replacing developers? Are we augmenting developers? Where do we go in terms of AI really shaking up, you know, the production of this code?
Yeah, I mean, I think, you know, it's never black and white again in terms of wholesale replacement of FTEs. It certainly will augment their roles. It'll change not just the volume of what they're able to kind of write and produce, but also the focus, right? In terms of there's different levels of code. There's some kind of more table stakes, you know, just keep the lights on type code, and then there's, you know, the more creative and envelope pushing code that's being written, right? So I think you'll see a shift in that, where some of the more basic code is just, you know, again, handled at a more AI level. I think SonarSource is a great example from a company perspective in terms of how, you know, it's not linear, you know, what disruption looks like. I think we get a question sometimes of like, hey, you know, SonarSource is a company that basically kind of checks developer code to make sure it is good and it is of high quality, that has all sorts of add-on positive benefits. You know, if that code shifts to AI, you know, what happens to a company like SonarSource? Does that just go away? And it's like, actually what we're seeing is the absolute opposite of that, right? With AI, you're seeing the actual volume of code being written by engineers, and with AI augmenting that, absolutely exploding. And with a company like SonarSource charging on the lines of code bases, it's creating really, really positive tailwinds for all of that, because, you know, as volume of code explodes, people are still going to want that to be quality. They're going to want that to be checked. And so it's creating positive tailwinds for companies like that.
Yeah. You know, both Thomas, you and Dion have really been talking about horizontal industries. You know, developers, you know, touch all industries. Software engineering is obviously embedded in every industry, and cybersecurity as well. But so Lonnie, but and that's very different than a question of, do we think it's possible to really train LLMs to accurately support all topics? And so, can we really think about specialized AI, truly vertical specialized AI? Lonnie, I'll lob that to you.
Yeah, we the wave of innovation out of the frontier labs has been pretty relentless. And so far, what we've seen is companies will train these special purpose Gen AI models on, say, like an industry vertical domain, and then the generic models will outclass them in that narrow domain as they get larger and more capable, and sometimes even cheaper and more efficient. So, but there's some notable exceptions here, right? So we have a portfolio company, Profluent, that focuses on protein design, so that tokens represent amino acids instead of text or images or videos. And this specialization allows them to generate proteins with specific properties. And this is not something the sort of regular language style foundation models are able to easily replicate. You're seeing the music generation systems like Suno and Udio, which, you know, kind of hit a tipping point over the last 6 months or so, where they, you know, didn't generate good music to now they do, and those are at the moment special purpose models, so they're not that you don't just use the regular foundation models to do them. But there is a lot of kind of multimodality that's coming online. Even just over the last week, we saw capabilities coming out of Google where they have image generation in the same model. So it's not a separate model that the language model calls to generate images, but rather the image is being generated out of the same latent space as the text or the audio. And we already had the multimodal capabilities like advanced voice mode from OpenAI, that where it's not taking your voice and turning it into text and then sending that text as a prompt and then responding with text and then turning that text back into voice. It just listens to the voice, and it can take those voice waves essentially and embed them in the latent space. And so you can interrupt it, it can understand and produce the tone, and it can produce accents, it can whisper, right? And it just has this much richer capability in the same core model. So I think we'll see a lot of that as well. But I would contrast this to some of the earlier generations of AI, the kind of more classical prediction systems and classification systems and recommendation engines, where things did tend to be very specialized, right? Where you would train a model on a large amount of example data to do something as narrow. And we have portfolio companies that are good examples of this, narrow, like finding cancerous polyps from a colonoscopy, or identifying whether you need a crown or a filling based on a dental x-ray. So those sort of pre-generative AI systems, the classical prediction systems, those tend to be more specialized.
Makes sense. That specialization, I remember the time when it was, a bespoke workflow to build a website. And then we had Wix and WordPress and Squarespace and a couple of these new, cloud-based subscription models emerge, where it was suddenly easy to have a website built in the cloud for you. But we are seeing GAI able to disrupt that. I mean, Thomas, you had an example you were talking to me about.
Yeah, look, I mean, I think this, as a market, website building is a great example of a very large market within software, where the only real inherent moat is just the usability from the perspective of the end user to be able to spin up a website that does what they want it to do. And it was who had the best UI to enable the workflow that made that experience best for the end user. Imagine a world where you could just, with natural language, tell the computer what you want the website to look like, or the web app, and what you want it to do, and where the buttons go, and what the functional elements and color scheme and all of that. Well, that has arrived, and that is a business we backed called StackBlitz. They have a product called Bolt.new, and it's been possibly one of the fastest growing, certainly the fastest growing company I've ever been a part of, but possibly one of the fastest growing companies in software. 0 to 4 million in 4 weeks, the first 4 weeks of launch, and it's been accelerating in the last 6 weeks since then. I don't know if they publicly disclosed, but there's a tremendous amount of buzz around that, and I think it just shows like how the sort of intrinsic moats of software and intrinsic stickiness, which I think that's an element that a lot of investors love. But if your moat is usability, and Gen AI has a potential to disrupt that, there's a very much a reason to watch out for. So
yeah, it's true. I mean, that's a great example of the kind of disruption where potentially this next generation of GAI is able to replace what was, even in those days, pretty innovative in itself. I mean, we're seeing this happen in a lot of older industries that may not even have fully adopted cloud-based solutions. Dion, we were talking about the legal industry, which is as old as any industry. Maybe you want to give an example.
No, I mean, I think you're, in some industries like legal, where like the barrier to adoption is that usability point. I think you're seeing the exact same things play out as what Thomas just described, right? You're seeing, Filevine replacing companies like Clio and LawView for the same reason that, it makes their interfaces makes it easier for the users to actually access the end outcome that they want. I think the story that you're seeing there play out is kind of very different than other industries where you're not seeing that same kind of leapfrogging happen, right? Like, another kind of vertical that I work pretty closely with is aviation. And if you look at, what the barriers to adoption on the technology front there have been, it has not been usability or kind of lack of technology, right? It has been, other buying factors that impact the vertical. Like, there's a tremendous amount of regulation and kind of like safety measures that need to take place with aviation for very good reason, right? And if you look at the companies that we're backing here, we just made a great investment in a company like FlightKeys. They offer tremendous technology to kind of support flight planning and operations, which directly targets, what airlines care about the most. Airlines care about fuel efficiency. FlightKeys targets, amazing flight routing so that they're able to save on those costs. And the technology that they have is like leaps and bounds better than, the technologies that they're displacing. And yet I'd say it's only now that they're really, really gaining traction for this technology that they have available, because the barriers again here are a lot more about kind of that regulatory and kind of safety concern. And if you're the CEO of a massive airline and you're being asked to bet your reputation and stake on a new startup AI company that does flight routing, the answer is probably going to be no and not yet, right? So I think all this to say, like, legal versus aviation versus other verticals, like, they have very different dynamics kind of fueling why technology is being adopted, why it's not. And it's just not simply a matter of is the technology there, but what are the kind of buying factors and decisions that kind of weigh into that choice.
Yeah, yeah. There are these industries where they didn't really embrace early cloud. They haven't really been able to embrace that kind of wave one of GAI adoption, but they may just go directly to kind of AI native products and really leapfrog in terms of innovation. I mean, Lonnie, that's a big part of what we're seeing in the healthcare industry, or what we could see as a prediction in the healthcare industry.
Yeah, the chassis that is getting built on here, the foundation models themselves, they're changing so quickly that even the product leaders at the frontier labs that are working on their products that are built on top of their models, so things like Artifact and Canvas, they don't know what the products are going to be able to do in like even 1 or 2 months. Even the researchers who are cooking the models in the lab don't know how accurate they're going to be. And in a domain like healthcare, this makes things really challenging, right? There's a really big difference from when there's a system that like can sort of answer medical questions, but it's not that good, and it's like kind of annoying, to like, it's better than the special purpose prediction system that you trained on thousands of images, and it's more accurate than a human, and maybe it's malpractice to let the human do it, right? And the difference between those things is just how, in many cases, just how accurate is it? Like, how good of a job does it do on the task? Is it 60% accurate? Is it 99.99% accurate? And and even as you scale up the model capabilities, there's other functionality that's coming online. So I talked about the voice and the image generation modality. Google also, over the last week, announced a system that OpenAI had demoed about 9 months ago or so, which allows you to take in video natively. I think it's mostly doing snapshots of images and then streaming them. But you just sort of like think about the kinds of healthcare use cases that could get unlocked if that video understanding was really good, right? And people, I think there's a little bit of a cognitive bias here. People have a tendency to, I've even talked to some prospects and others, product leaders, and they have this mental model which is like, okay, so the models cannot do X reliably today, and therefore will never be able to do X reliably. And it's like, well, that's already not been true even over the last 12 months, right? We saw things that people were talking about last year that were, insurmountable computer science challenges with respect to the architectures of these models. And you only had to wait like 45 days before the problems were solved, like the ability to do math, right? You now have access to code interpreter, and they can write Python, and they have calculator access and things like that. And so I think, but the really interesting about healthcare, and I think laws like this too, is they've in many cases been very resistant to softwareification. And these capabilities, as they come online and get more accurate, have the potential to bring the power of software to these very important but historically not as softwareified industries.
Yeah, makes sense. I mean, we have one more example of this, and it is the cement industry. You probably couldn't get anything more concrete than that. So Thomas, why don't you give us that, and then we'll move on to some bigger predictions.
Look, very briefly, I mean, this is just a classic. Of course, as VCs, we're already talking about the next paradigm, which is Gen AI. But, it's important to remember that cloud native and just SaaS in general is still a high growth trend. And there's still a tremendous amount of on-prem workloads that exist out there in various industries. And there are industries that just happen to be late adopters and laggards in the first wave of SaaSification. And so earlier this year, our team led an investment in a business called Cystine. They market themselves as ready mix software, serving the cement and concrete industry to help them manage all elements of their operations. And so it's a great example of a cloud native product and first wave adopter of, a first wave adoption of SaaS. And potentially will be a fast follower into Gen AI. Perhaps, the concrete and cement industry will be, ahead of some other industries in terms of Gen AI because they'll be so quick to adopt software. So
yeah, the vanguard. I'll believe it when I see it. We'll turn our predictions now away from the kind of tech industry itself to more of the macro picture. I mean, if I were to evoke Shakespeare, which is what I started with, for those of you who joined late, the sentiment around this would be, if all the world's a stage and all the men and women merely players, which is from As You Like It, and really talks about, in other words, we work with the hand we dealt with. And so, our fourth and fifth prediction last year were that the market would return to normalcy and that we would start to see M&A pick up. And certainly we've seen both of these trends play out. Insight had two very large strategic acquisitions this year. Salesforce bought the own company for close to $2 billion, and MasterCard purchased Recorded Future for close to $2 billion. And so our prediction for this coming year is that the pace of M&A will continue to pick up. And so, Lonnie, why don't you talk a little bit about our predictions around that? The Fed has obviously lowered interest rates. It's more favorable. And we've seen a little bit of these tailwinds. What's your thoughts around M&A in next year?
Yeah, we saw a enormous pickup in M&A activity in 2024 compared to what we had seen over the prior 24 months or so. I think a couple of things had happened there. One was that acquirers probably had a backlog of deals after what was effectively a multi-year pause as valuations were softening and we were coming out of the economic stress from the pandemic. And then, so just within my own company that I work with, I had Deci AI and Run AI, both of which had announced acquisitions by NVIDIA earlier this year. Featurespace, which had an announced acquisition by Visa. Thomas has many more acquisitions, and Dion as well. And so I think what we'll see in 2025 is that will continue to be pretty active. The acquirers are going to continue to care about not just product capabilities, but also having the world do some of the work for them of figuring out which companies are durable and good. So you're going to see interest in things like operating leverage, like high gross margins, high gross retention rates, high net retention rates, lots of net new ARR being added, sales reps joining, getting productive quickly, staying productive in a consistent way. Things that are not guarantees, but strong signals that if you pour more human capital and financial capital onto the business and give it access to a much broader distribution base, that you will get a lot of value from it. And then, of course, there's also interest in acquiring highly differentiated assets that represent sources of economic power. So things that have network effects and data moats and teams that are really good at product craftsmanship and those kinds of things.
Yeah, that makes sense. And, a lot of companies were funded in 2021 at very high valuations. They had a lot of capital. They may not have grown as fast in the last 2 years market conditions that warrants the next round of capital. They may not have the proof points like you just talked about, Lonnie. And so, Dion, when we think about M&A for these smaller companies, do you think we'll see more of that? These smaller, potentially, we often talk about the fact that sometimes in 2021, features were funded instead of products, and products were funded instead of solutions or platforms. Do we see the merging of that in order to create some of these bigger, more comprehensive solutions?
Yeah, I do think you're going to see that. I think we're still a ways in terms of seeing the aftermath of 2021 play out. I think if you think about what happened in 21, as you mentioned, Hillary, there were a lot of companies that got funded on kind of, feature as opposed to kind of revenue per se. And so it was an early bet. And a lot of these companies were kind of, funded at very, very high multiples. I think post that first crash, you saw some of that wash out and play out, right? With companies that just had extremely high burn and weren't able to kind of cut that. And so you kind of saw that first wave of damage play out. But I do think there remain just a really, really long tail of companies that, raised a lot of money in 21. They were able to kind of cut burn to a level of sustainable spend such that they're still very much operating today without having had to raise to date. But, I think a few years down the line, we're going to start to see even that extended burn begin to kind of come into question. And, I think there's a few paths they'll take here, right? There's some companies who in that time would have managed to kind of, really translate that product and feature bet into revenue and into ramp that can then go on and generate further rounds of funding. I think there's a few that even if they are doing pretty well, like, the valuation of 21 will just continue to be disconnected from where they sit today. And I think, raising another round from a fund, could be difficult for these guys because, the financials just might not make sense, right? It just might not make sense for a purely financial buyer to kind of buy into a cap table like that. And then, so I think in that context, I think you will see a lot more openness to kind of strategic exits because they do have kind of just different criteria and are able to kind of make a bet on a company for their product that could be a little bit divorced from their financials. And so I think you'll see both in terms of just that is the exit option they have available to them, combined with, you're seeing strategics, themselves want to grow a lot faster, right? And wanting to kind of add growth levers on their own. Coupled with, I would say like a macro administration, where there might be, less fear of antitrust and more openness to kind of let companies acquire. I think you'll see a lot more strategic activity in the coming year.
Yeah, I mean, that's a good question that you raised, or just a thought that you raised. Then it was a question that we had from several of the participants. You all provided some thoughts when you registered, which was what changes in the current political climate? How does the incoming administration impact M&A? Thomas, do you have any thoughts on that?
Well, look, in general, I agree with Dion that for a lot of investors that are in the long, flat part of the return curve and don't see an ability to dig out of that, getting your money back now versus waiting 3 years to have the same result and kind of clearing stuff off your plate is going to be an inclination. And, combine that with, an expectation of lowered interest rates or at least some stability there in the downward direction. I think strategics are going to start to realize, or have already started to realize, that things are not going to get much cheaper, and it's probably going to get more expensive over time if they wait. So, now is the time to strike. And, as it relates to the question on the administration, like I've been watching somewhat more closely than I expected, I guess, on what some of the new leaders in, sort of antitrust and all that what they would look like. And I think there's still going to be a lot more of the same in terms of big tech regulation. And, I think administration and group that's not going to be super friendly to big tech driven consolidation. So something to be mindful of, but toward little tech and, maybe stretch, acquisitions that might be a stretch to be considered, antitrust, but might have gotten more scrutiny prior. I think it's going to open things up. And so, in general, I view there's going to be somewhat of a thawing there, and a little bit less concern. But I think if you're one of the hyperscalers and the big names, there's still going to be a tremendous amount of scrutiny. And I think there's going to be some interesting moves that might take place in terms of, what the future holds for some of those companies.
Talking about opening up, ServiceTitan went public today. So, Lonnie, what's our prognosis for IPOs in 2025?
Yeah, I mean, even though there's been a bit of a concept in the zeitgeist that the IPO market has been closed, we have seen some IPOs. So not just ServiceTitan pricing today, but we also had Reddit and OneStream and Rubrik. And so you see a bunch of companies that are able to go public, starting around, call it 200 million or so in ARR. But you need to have a number of qualities, right? You need to have all of the major and important C-suite executives in place at least 12 months in advance. You need to have really good visibility into beating and raising for at least, a year or so, as well as like a credible storyline around product innovation, go-to-market innovations that signal long-term growth and durability and profitability. If a company grows at 50% a year for 10 years, it's about 50 times bigger. If it grows at 50% a year for 20 years, it's 3,000 times bigger, right? So, and that's not a thing that never happens, right? We've seen that with companies like Google and others. And that kind of long-term durability is a lot of what's being underwritten in the public market. So you want to see all of those signals of operating leverage that I talked about earlier. You don't necessarily have to be profitable, but you need to signal that you have operating leverage, right? So things like high gross margins and high gross retention rates and things like that are really strong signals that you could become profitable over time. Or at the very least, what you're effectively doing is reinvesting your profits in a way that's extremely productive and high leverage and high return. And then I would just say, there's a couple of really key roles, like an experienced CFO, that are absolutely critical. And so we've been doing a lot of work at Insight to help our companies with this kind of IPO prep, because there's actually a lot of things you can do well in advance.
Yeah, that's true. And that durability is what we look to see when we fund in the earlier stages, in small scale ups and startups. And so our prediction number 4 really is, high growth with significant potential will continue to command high valuations. But, this year, although we've seen the investing logjam free up, we have seen very moderate valuations. So, the valuation ranges have been trading at 5 to 7 times for public companies and maybe 8 to 12 times for venture-backed deals. Where do you think valuations go? Certainly for the founders on this webinar, Thomas, what's your perspective for the kind of classic Series A, Series B, growth equity deal? What do you think the prognosis is around valuations?
Well, of course, it depends whether I'm buying or selling. But look, conventional SaaS investor wisdom was like the top tier is the triple, double, and you kind of make some sort of an underwrite based on that if you're showing kind of the signals that imply you're on that trajectory. And I think that companies or investors that had invested at 10x plus types multiples and experience those kinds of trajectories ended up doing decently well. Then there was all of a sudden this kind of dislocation of discipline toward 20x forward, and then we're making up forward numbers too, and so it becomes very difficult to pin down. I think ultimately, or there's been enough hard lessons learned that we're not as dislocated as we were in SaaS valuations back in 2021. And I think some of those lessons are reflected in terms of current market conditions. But if you've got the proof points, certainly you're able to command toward that 10x forward type of range. And then there's these exceptional cases around AI where either it's an incumbent that has got a sort of a fresh shot in the arm from a new generative AI driven kind of use case or adoption vector, or companies that just simply break the model of triple, double. It's like you go from 0 to 4 million of ARR in 4 weeks. How do you value that? 10x is probably not necessarily a realistic sort of base case anchor. So, 10x next week's ARR, that's so you have those situations which are really probably throwing a wrench into the conventional valuation wisdom and into, the complex valuation models that all of us investors maintain behind the curtain at our own firms. But look, I think the reality at the end of the day, you have to look at the public markets to anchor yourself. I've seen a lot also on the more the private equity driven sort of sponsor-led processes or sponsor-backed strategics. And, the clusters there, 10x is not a given by any stretch. And I think it's important to just keep that in mind for any founder that's listening to this, that 10x is a phenomenal valuation to sell your business. And again, remember, raising a round is very different from a liquidity event. And I think sometimes that disconnect is not always appreciated.
Yeah, and that's fair. And some of this disconnect, I think, we have seen this dichotomy in the market, which is that, that we've seen very, very high multiples for some of these AI infrastructure deals. Are these rational, Lonnie?
I think it's useful to try to keep two thoughts in your head at the same time about that topic. So one is that the wave of innovation itself has enormous potential to transform the software industry in various ways, certainly has big implications for software investing and sources of defensibility and all of that. On the other hand, not all of the investments will work out, and some may turn out to be very disappointing. So like just as an example, in the frontier lab space, you have the kind of 5 leading frontier labs, but then you have another dozen or so that have raised hundreds of millions of dollars, often at extremely high valuations, with a situation where they have a enormous amount of capital going into a very rapidly depreciating asset, right? That model you built for $500 million 6 months ago, right, is already obsolete. There's kind of unpredictable levels of churn, right? There's a number of even Gen AI application companies that grew really rapidly early on and then started to churn pretty quickly as someone else released a version of that thing that was better. And you have price drops that maybe are faster than anything in the history of the global macroeconomic system. You go from something like GPT 3.5 to GPT 4.0 mini, and you've got 97% plus price drops in around a year for a product that's higher quality. And so that's all happening at the sort of foundation model level. And then at the next layer, people will sometimes refer to as infrastructure tools. There's been a lot more infrastructure tool capability being shipped by the frontier labs than I would have expected. It's certainly more so than what we saw in some of the previous platform shifts. And so, they're not just shipping the models, they're shipping eval tools and embeddings APIs and frameworks. And, we saw it with cloud computer use, the ability to do basic RPA. And many of these infrastructure capabilities are better when they're deeply infused at the design time and in the pre-training process. And so what I would say is it's not that there isn't really interesting infrastructure software to do within AI. Like our portfolio companies like Run AI and Weights and Biases and a few others are really good examples of how you can build incredible franchises at the infrastructure layer. And we're pretty good at Insight at handling platform shifts, right? Like when you go from on-prem to the cloud, there's still databases. You still need databases. They're different, right? You have separation of storage and compute and dynamic elasticity and all sorts of other architectural differences. But here you just need to have a very high bar, right? Because if you have a product and it's just not that good compared to what's being produced by the frontier labs built into their models, you can be in a pickle pretty quickly.
Yeah. Just picking up on that, I saw a comment in the chat from Rob Bailey, who's the CEO of Crew AI. Maybe you want to just talk about why we would lean into something like a Crew AI.
Yeah, I mean, the kinds of things that we're looking for at the infrastructure layer are, so you can have a product that is technologically differentiated, right? So you have talent and technology as a source of defensibility. That can last a couple of years. And then what you need to do is you need to transition to a more durable moat during that window. So what I mean by more durable moat, these can be things like, talent network effects, right? Weights and Biases, for example, really enjoys this phenomenon of people will bring their knowledge of how to use that tool set with them from company to company. It's just easier to find people who know the tool set for experiment tracking and hyperparameter optimization and all of their newer capabilities. It's just easier to find them in the market. You start to get platform effects, right? If you're going to integrate with one agent framework or one, sticking to the Weights and Biases example, if you're going to integrate with only one hyperparameter optimization and experiment tracking tool, right? They're going to be at the very top of your list. And so you could try to use something else, but it's not integrated with everything else. So those are the kinds of things that can, and then over time you start to build some real sources, significant sources of durability around just scale, right? You're bigger, you have more brand power, you have more brand awareness, you can amortize fixed costs like marketing and R&D over more revenue, things like that.
Got it. Makes sense. I want to talk about Insight's secret sauce, which is really we invest at the early stages. We do Series A, Series B, and we invest all the way across the spectrum to larger companies, more revenue, more stability, potentially slower growth, but definitely more profit or close to profit. And so, Dion, you've dealt a lot with some of these more private equity type profiles, and you've definitely led several private equity exits from our portfolio this year. So, what are PE investors looking for in terms of M&A? What kind of multiples are they looking to buy, to be funded at, and or to invest in? And when they've invested in portfolio companies, those companies themselves are doing M&A. So perhaps you could talk a little bit about the valuations in that kind of larger world.
Yeah, sure. I mean, we've talked about it a little bit today, but we are entering a period following a really long cycle of investments being made with very little liquidity generated across the board, right? So there's just kind of been this backlog of just great assets that a lot of funds have held for a really long time. And now for the first time in a long time, these assets are being offered for sale. And so what you're seeing in this environment is you have a lot of private equity buyers who have been tracking assets for a long time. And so they know what the A assets are. They're willing to pay A+ prices for them because, I think they're limited and they know exactly the logos that they want. And they're gravitating towards those assets. I think to your point, Hillary, it's one of the reasons, we at Insight kind of enjoy the ability to kind of get in earlier, because when you're entering just at this stage, it can get pretty competitive. I think at the same time, there is an absorption rate that continues to exist in private equity. There are, only so many logos who can write a set number of checks. And so, you're seeing a little bit of kind of a polarization of A assets getting A plus prices and, kind of B assets getting C prices, right? So I think, we're seeing some of that play out. I will say though, for kind of both of these asset types, private equity buyers are able to just they have more levers to underwrite to today than they have in the last few years. The buy and build market is really, really healthy right now. And so, folks are able to take even B or C assets and kind of create, avenues of growth around them from a buy and build perspective. AI is providing another massive lever that folks can underwrite to. Alana, you mentioned this a little bit earlier, but one of the companies that we work closely with together is Central Reach. And, this is an incredible asset that has performed very well over the last few years. And now, we're seeing a whole new phase of growth open up in front of it in the form of AI, and they're able to really dramatically expand the TAM they have in front of them. So, I think, again, the environment continues to change, but these are some of the dynamics at play here.
Yeah. In the last 10 minutes that we have left, I want to continue to zoom back out. So we went from tech specific to kind of market dynamics, valuation dynamics. And now let's talk about society kind of as a whole and the impact of some of these new innovations on, just what we're seeing broadly in society. Our fifth prediction is that as existing rules are augmented by AI, the shape of business operations will change. Thomas, any thoughts on, how AI systems interact with other AI systems? Is AI going to be used to police AI as we think about, the impact of AI at large?
Yeah, look, I mean, I don't know if there are any fans of the movie Blade Runner in the audience, but for those who haven't seen it, folks, the Blade Runners are the specialists that can hunt down malicious AI. And, those are shape-shifting entities that are hard to pin down. And we're not very far from the types of, malware that are agentic in nature and that are literally going after our systems in a way that, as I described earlier, just like an attacker can trick someone with a phishing email, one agent can trick another agent with a certain type of prompt or cleverly engineered sort of approach. So, look, I think that's absolutely a cause for some level of concern. I think it's also just speaks to the really dramatic potential that these new types of software have for productivity and gains and good for humanity as well. So
Yeah,
it'll be interesting to see.
so as you think about new roles emerging, Dion, any predictions for tech hiring?
I mean, I think we've obviously spent a lot of time talking about AI and the kind of, the role that data will play in all organizations. So I think you'll definitely see that, right? There's the kind of widespread adoption of CDOs, across orgs. I think within that, there's also going to be shifts in the composition of data-oriented roles. So for example, a new trend you're seeing now being pushed by kind of the Snowflakes and Databricks of the world is the push on serverless. So you're going to see moves like that eliminate the need for infrastructure management and kind of shift the kind of composition, again, of these types of orgs.
And Lonnie, are there roles that are going to be defunct as a result of this?
The way I think about that is there are the main effect of something like Gen AI is to drive down various types of prices and costs. And then there are some human tasks and roles and companies and maybe even industries that are kind of more what economists would call complements. So they become much more valuable, sort of the way when the price of a electric battery comes down, right? The electric vehicle becomes much more valuable. It suddenly becomes a viable consumer product. But we saw this with mobile technology, right? Where prices of GPS capability and mobile phones went down enough, all of a sudden new business models and entirely new industries like Uber or Upwork get unlocked. And then there are other things that are economic substitutes, and these are things that become less valuable. This is what people mean when they say things like, the robots are taking our jobs, or this business is getting disrupted or commoditized. And then a really big ingredient that I think people will often miss is the impact of the elasticity of demand. So even within a firm, right, there are some tasks where there's an insatiable amount of demand for that task, and other situations where there is actually a very fixed amount of demand. As one I make fun of the corporate logo redesign industry sometimes, which is, like you see this orange logo on all of our screens, right? Like if instead of costing $15,000 to redesign a logo, all of a sudden it's only 10 cents, everyone's not going to rush out to change their corporate logo, right? There's kind of a fixed annual demand for redesigning your logo, and it's not primarily based on price. But even within our companies, we see enormous amounts of demand for things like software engineering. And so as the cost of those things go down, even within a firm, certainly between companies, you can see a massive increase in demand where the price can go down 90%, but the market can expand by 10x, so 100x on a per price basis. And then there's also just a lot of what I'll call re-bottlenecking that will happen in certain activities, right? So you may see software engineers get 25% more efficient because they're using code gen AI systems to improve things, but the work will suddenly get re-bottlenecked at software testing, like the kind of thing that our portfolio company Tricentis can help to solve, that Thomas and I work on together. And so like that type of thing ends up being you kind of have to map this out, task by task, role by role, industry by industry. And we've been doing a lot of work in various sectors to do that.
Yeah. I just am reminded, given that the battery on my computer died, and so therefore I dialed back in on my cell phone. But energy is everything, and if you don't have the energy, none of this is real.
Good
And
save,
so
Hillary. Wow.
I know that was a quick flip to my phone. In the last few minutes, I'm going to do a quick lightning round and ask each of you, what's your most controversial prediction for 2025? And Dion, we'll start with you.
Controversial, but if people can kind of squint at like what the big topic was before AI is ESG, and I think something we don't talk about enough is that AI and data compute is not free. To your point on batteries, Hillary, like everything requires resource. So I think we'll be asking more and more questions around like, is code written in a sustainable way? Like, is this actually written in a way that achieves the most efficient compute expenditure? And see those themes start to merge.
Thomas.
Yeah, I mean, maybe if we've seen all these foundational model companies raise eye-popping levels of capital at eye-popping valuations, and so I guess the question will be, how sustainable is that, and the economic model and moats that they have, and to what extent will that shift to the hyperscalers themselves, who have capex budgets that make XAI and OpenAI and Anthropic's rounds look like really drops in the bucket. So. And I know I've heard some examples, including from some of Lonnie's companies, where they're seeing dramatically lower prices and dramatically higher speeds from the hyperscaler models than those offered by the LLMs themselves.
Yeah, and to that point, it's how you price this, and are they going to be able to take some and extract some economic rent from this? And if you haven't watched our podcast on, our webinar on AI pricing, please look back on our blog, because we've done a lot of thinking into how AI will be priced and what those kind of pricing models will do. And so finally, Lonnie, hand it over to you. What's your controversial prediction for next year?
Okay, so there's this idea right now in the people are talking about in the AI discussions around this wall, the idea that the models will suddenly stop getting better, or maybe have already suddenly stopped getting better, or there's going to be some dramatic decrease in returns to increasing investment in the models, and the capabilities will like really slow down. And so my controversial view is that we haven't hit a wall, and we're not going to over the next few years. The models are going to still get better at an extraordinarily rapid pace. And the way I would sort of frame this is a little bit like what we saw with microchips, right? Like even when you saw things like the Dennard scaling, the scaling law that says basically that as transistors get smaller, their power density stays constant. Even as that started to see diminishing returns, which took, I think, a lot longer than people expected in many cases, you were able to do other things to scale out these chips, and computers haven't like slowed down in how quickly they're getting better. You have, multi-core systems, and now we have GPUs, and, even in the scenario where GPUs start to get more expensive, you're going to have similar returns to reasoning capability from other techniques like new data sources, higher quality data, the like O1 inference time compute capabilities, new architectural innovations. And then I'd say like my most controversial aspect of that view is that we haven't even hit a wall yet with the basic pre-training scaling, just given the kinds of threshold effects I was talking about earlier, where like as you get more accuracy, it unlocks entirely new magical capabilities.
Got it. Well, thank you. And to quote Shakespeare, who has been enduring, and that's what the kind of businesses we're seeking to fund and build. Macbeth remains enduring. So I'll leave you with the following thoughts. In Macbeth, he's asking the witches, and he says, if you can look into the seas of time and say which grain will grow and which will not, then speak unto me. Well, we hope we've spoken unto all of you. We've given you some predictions for next year, and remains to be seen this time next year how many of those are prescient. So thanks everybody for joining. I will hand back to Deanna.